welcome to the Banker Magazine Financial Institutions Group Roundtable, filmed at the Financial Times headquarters in London. My name's Philip Alexander, I'm the finance editor of the magazine, and we have with us here today 5 senior global markets and investment bankers, all of whom specialize in the financial institutions area, to discuss a landscape that has changed fundamentally, both in terms of market conditions, the wider economy and the regulatory environment since the period before the financial crisis. And I'll let the panelists introduce themselves now.
Good afternoon, my name is Mark Templeman. I head up FIG, Debt Capital Markets for Europe at Bank of America Merrill Lynch.
Good afternoon, I'm Eric Richard. I co-head the Financial Institutions Group at Credit Suisse, and I joined Credit Suisse 11 years ago.
My name's David Marks. I'm chairman of Debt Capital Markets for JP Morgan in Europe.
Good afternoon, my name is Ralph Crossman. I'm head of covered bond origination at Societe Generale.
I'm David Soanes. I'm responsible for financial institutions, banking and capital markets in Europe for UBS, as well as being the deputy head of global capital markets at UBS.
If we kick off, really looking first of all at the current environment in the market and the conditions for bank financing and for raising bank capital, maybe I'll start with you, David, to talk about the concerns about sovereign debt and what sort of impact that's been having on the market for bank financing.
Well, certainly I think the sovereign debt concerns are front and foremost of all concerns that investors have at this particular point in time. I think there's really 3 orders of concerns, not just that investors have in FIG paper, but across the board, and that's the outlook for economic growth in China and Asia, the outlook for growth in the US, and then clearly the outlook for growth in Europe, where the key determinant is going to be how the sovereign debt crisis resolves itself over the next, I wouldn't say months, but indeed the next few years. Obviously, in terms of the impact on FIG debt financing and equity financing, it's extremely diverse. I mean, if you're a national champion from a northern European country, you've got access. Risk premium have certainly increased, but you've pretty much got access throughout the capital spectrum. Certainly much better access than, say, in Q4 2008. If you're even a national champion in one of the afflicted sovereigns, your access, even on a government guaranteed basis, is clearly highly problematic.
And David Soanes, if I might bring you in here, I mean, what kind of strategies can some of the banks in that sort of southern European region pursue to cope with the current conditions, or is it really, a question of wait and see at the moment?
I prefer David's question. I mean, this sort of the have-nots and the have-lots, which is what characterises the financial apartheid, makes it really quite difficult for the people who aren't considered to be blessed by the markets to raise funding. And just at the sovereign level, if you go back to April, I think the yield on a 10-year Spanish bonos was around about 410, 420, something like that. And the yield on a UK gilt around that time was about 410, 420. And since that time, there's been this tremendous divergence in yield. So it happens very, very quickly. And what let the UK be safe harbour versus Spain? There are reasons for it, but it's not. You can't really distinguish it at the time it happened. And I think that's true for banks right now. If you are a bank who's got access, you don't know if you're going to be able to persist with that access. So therefore, if you do start borrowing money at these elevated spreads, you don't know whether that, if you fail, you try a deal and it doesn't work, whether that pushes you into the camp who can't raise money. Equally, if you succeed, people think, well, you paid a lot for that. Does that change your curve for the rest of time? So you've got to be, it's very tactical even for the people who can borrow. For the people who can't, clearly there's still a lot of confidence in their assets from the central banking business. So they turn up to the central bank with their assets, the central bank provides them with repo.
Eric, if I might bring you in here, obviously this distinction being made between Spain and the UK, and one of the questions that's doing the rounds is, do we know for sure that in terms of the asset situation of banks that the problems that there are now out there? And I guess obviously hanging over Spain is this question of what's happening with their real estate exposure, what's happening with the position of some of the smaller banks there, the caja sector in particular. Do we have a clear view on that emerging, or is it still a little bit up in the air?
In terms of the rest of the asset base, a lot of work, a lot of analysis has gone in the last 3 years in terms of forming a view on the quality of the assets of the various European banks. And if you take the specific example of the Spanish banks, clearly there has been a lot of scrutiny. I'm still not sure that we know exactly where that's going to go, if anything, because we do not know exactly what the prospects of the overall economy is going to be. And the asset side of the cajas is obviously very dependent on where the economy goes. So as long as there is a question mark there, and as long as we don't know when the economy is bottomed out, you don't know how far the assets potentially can deteriorate. I think what clearly has helped over the last few weeks is an acceleration of events caused by the creation and the implementation by the Spanish authorities of the FROB, which effectively that fund being there has encouraged the cajas to indeed do what had to be done. And without that, and without that deadline of the 30th of June, there was a possibility that whatever uncertainty that was in the system was going to be there for a lot longer. So I think from that standpoint, that has been very beneficial.